Yes, Mr. Ghosh.
I'm grateful. Please, then, may I take the court to... Is that still right? Yeah, well, it clearly is. Yes, you can hear me. Please, may I take the court to the FTC decision, starting, please, at page 178 of the electronic bundle. I've already told the court that the facts, they're set out at paragraphs 11 to, well, actually 17 on pages 175 to 178. So this is all to do with the accounting treatment. Why do you get a debit? Paragraph 18, that tells us we're talking about IFRS 2, that's all right. Paragraph 19 tells us there were iterations of that, but not material iterations. It used to be combined with a standard called an IFRIC, then the IFRIC was simply incorporated into IFRS 2. Paragraph 20 tells you, and this is why I showed you, because Mr. Henworth's expert opinion, yes, it's the EBT trustee that grants the option, but you apply IFRS 2 as if it was the holding company. This grant of an option is what's called a share-based payment. It's a grant of an option to an employee, and it's settled in shares. Now, the answer I've got to my Lord Briggs is there's no finding of fact in the FTT that they can be cash settled. Those instructing me looked at the rules, and there's nothing that says they can be cash settled there either, so it's a tentative no.
Okay, thank you very much.
So it counts as an equity settled,
yes,
share-based payment? Well,
yes, I mean, and for the purpose of IFRS 2, it absolutely counts as an equity settled. 22 is what I've been telling the court all along. Paragraph 7, which you've seen, is all to do with saying that there's an issue of an equity option. And the consideration, not a lawyer's consideration, but an accountant's consideration, was the receipt of incentivized services, but they're treated as consumed entirely on receipt. Now, if this court treats this case as a case about companies consuming employee services and paying through the recharge for that consumption, it takes on completely the wrong complexion. This case is about a company, a parent company, that's issued an equity option. The benefit of that to its subsidiaries is treated as an incentivization, and the recharge is a payment to the parent for granting the option. It's the grant of the option that you'll see is the capital contribution. But anyway, at 22, you'll see, this is what paragraph 7, and I've shown you paragraph 7 of IFRS. What's happening, and this would be just the same as my Lady Rose was investigating and interrogating this morning, if it was a singleton company with its own employees. And of course there'd be no question of a recharge. At 23, now this is coming on to the business end of explaining the debit. Paragraph 23 sets out the controversy that surrounded IFRS 2, because they're saying, look, there's no expense here. There's no, until IFRS 2, there was no way for companies to account for the issue of equity options to employees, not the ones that were settled by shares alone. And over the page 180 of the electronic bundle, you'll see the heading, there is no cost, therefore there is no expense. That was the argument put to the drafters of IFRS 2 to say, well, you shouldn't be doing any of this. This is silly. And taking it short, but this is critical. I'm taking it short because it's there for the court to read. But this is the essence of everything I'm submitting on the accounts. There's no cost to the entity on the issue of the equity option. So you shouldn't be accounting for anything. That's what they said is unsound, because they're saying there is consideration. As I say, it's an accountant's notion of consideration. There's no outflow of cash or other assets. But the expense arises from the consumption of those resources. What are they? It's the incentivization of the employees. And that is what Mr. Henworth said uncontroversially at recorded at paragraph 24. That's why I'm saying over and over and over again, IFRS 2 is not looking to compute profits in any normal sense. It's not like William Grant or these other cases that say the accountant's got a way of computing profits. Tax code shouldn't interfere or disturb or qualify that. This is IFRS 2 saying something's happened, there isn't a cost, we want to account for it, but the thing you get, what it calls consideration, doesn't get to be booked as a balance sheet item. To preserve the integrity of the balance sheet, put it in P&L. And that's why I've said over and over and over again, the recharge is not a charge, a payment for the consumption of employee resources, employee services. It's a payment to parent for granting the option. That's not controversial. So my respectful submission, the articulation of this case is this is not a case to do with the consumption of resources and a payment through the recharge for the consumption of those resources. This is a case about the accounting for the grant of an equity option by a parent company and how it is that as a matter of accounting there's a debit to P&L because the integrity of the balance sheet needs to be preserved. Now, in the Court of Appeal, I was challenged several times by my Lord Justice Richards, who said, well, what if these were gold bars? Why is that any different? If somebody grants an option, they get gold bars, or the capital contribution is gold bars, why is that any different? The answer is that's not just different, that makes all the difference, because that then is mine, it's a balance sheet asset, and if I spend it, I spend it. That's the expense. If there's a capital contribution of money or gold bars, the double entry would be credit capital contribution, debit gold bars. And then if I spend those, it'll be debit P&L because I've spent something. That's not this. That's saying, I think the court's got it now, you haven't got something ever that you can put on the balance sheet. But this is arising because and only because a company has issued an option. That's what this case is about. And that's why my respectful response to Lord Reid, where he says, well, what am I doing? This is seismic. You're saying accounts don't show a true and fair view. What are you doing? There's squads of cases saying you should follow the accounts. And I say, I know that. I don't need to be told that. IFRS 2 isn't doing that. Now, before I work myself up into anti-IFRS 2 rage, I'll progress to paragraph 24. And you'll see the last sentence, the rationale for this debit is that expense is not the sacrifice of cash or other assets, the consumption of services that the employees provided to the appellants. That's what the thing that's being consumed. Treat as an expense because and only because you can't treat that as a balance sheet asset for what the issue of the equity option. This is not a case where we're dealing with the debit for the consumption of employee services and the payment of recharge. 25 to 28, so 180 through to 182, that's just to do with the valuation of the option. Because they're saying, look, this, and my Lady Rose has already identified this, if you're asking, well, what is the quantum of this expense? What is the quantum of the capital contribution? Because it informs both, actually. Because the capital contribution is the value of the incentivized services. The FTT has written it as if this point is only relevant to the debit. It's not. It's relevant to both. The valuation, the quantification of the credit, capital contribution, and the debit, P&L, because you're talking about incentivization of employee services, that's far too difficult to actually effect, to do. So we'll just take the value of the option. Paragraph 30.
That's the market value of the option.
Fair value of the option as measured by, I think it was the Black-Scholes. Then we go on to paragraph 31. Now, my complaint, if you read paragraph 31, the grant of the options to the employees required the appellants to recognise the debit. Principles of double entry accounting mean that this debit had to be matched by a corresponding credit. So the approach of the FTT is, the debit's the important thing. Oh, you've got to put the credit somewhere. It's a capital contribution. That's what paragraph 32 says. That is not true. That is an unfair and misleading categorization of what's happening here. It's the issue of the equity instrument by parent co that explains both the credit and the debit.
So you say he's got this the wrong way round, really?
I'm saying he's paying no respect to the credit side of the transaction at all. I'm saying it's not that the credit's more important than the debit. You look at them both together and ask, where do they come from? And the explanation of the accounting is that this is a capital contribution. That's how it's booked. You can see what's coming. No balance sheet asset. Put the expense, but expenses in inverted commas. Bearing in mind the explanation of IFRS 2 says we recognise there's no cost. We recognise there's no sacrifice of assets. That's what I'm saying is express. (33) I think is also unfair. He's looking at the recharge now. And he's saying, oh, they're calling it a capital contribution, but goodness me, look at the recharge. That money's being paid back. Why would you call it a capital contribution in the first place? That, I say this respectfully to the FTT judge, is a complete misunderstanding of the accounting for this transaction. The transaction says there's a capital contribution, therefore credit capital contribution, debit balance sheet asset. Whoops, you can't put the debit into the P&L. Now we can look separately at the recharge. What does it do? Answer. You'll see at 33, there was a choice. The accounting is a mess. But 33 and 34 says, well, you can treat the recharge as reducing the capital contribution, repaying it. That's what happened here. That's what happened in this case. Treat it as an expense, but it would still be an expense which isn't reversing out the debit. That debit stays there. Or treat it as a distribution, a dividend. Either way, there's a disconnect in any one of these three explanations, but the one we're dealing with is a repayment of the capital contribution. There's a disconnect between that recharge and the so-called consumption of employees' services. you're one way or another paying money to a parent company because it granted an option. (35) and 36 simply makes this point. There was a what Mr. Henworth said, and this is reflected. I'll take you there very shortly in the analysis of the parents accounting 37 through to 40. A conflation of the recharge with the equity option. This actually taps into what my Lord Reid was saying, I think, this morning. You have to look at the two things separately. IFRS 2 deals with the non-recharge world. That's the only reason you've got this debit. That's the only reason. The recharge is happening because of IFRS 2.
Sorry, do you mean the debit is happening because of
IFRS 2, nothing to do with the recharge. And that's equally true of the parent. Because if the court looks at 37 through to 40, or actually 41, I can explain this very, I think, relatively easily. I said, look, if this is true, everything I'm saying about this is a capital contribution, it's been repaid, it's nothing to do with you can't have a balance sheet asset, that's why I got the expense, there's no real world cost, even the recharge doesn't change that, because the repaying the parent for issuing the instrument has nothing to do with, literally nothing to do with the consumption of services. That must also be true, if I'm right, for the parent. And at 37, you'll see that the tribunal records that, oh, well, the respondents in this case didn't think the parents' accounting was relevant. I think it's critical because it reflects everything I've been saying. What happens? If you remember this morning, 37 through to 41 tells you how Holdco accounted for this grant of the equity option, credit liability to equity, because it's my shares, debit, a real debit asset, investment in subsidiaries. And it's a subsidiaries, credit capital contribution, debit P&L. But because of the recharge, what 37 through to 41 is saying is what the parent company did was it kind of short-circuited everything and had a shortcut double entry of credit liability to equity. Yes, I've got to issue shares, debit cash. It should have taken two steps. It should have been credit capital liability, credit equity, debit investment in assets, credit investment in assets because the capital contribution is being reversed by the recharge, debit cash. But they just short-circuited it and said, oh, okay, at the end of the year, we'll just say the end result ends up being liability to issue shares, and because of the recharge, credit cash. So, unpacking all that, the accounting entries for parent 100% reflects what I've been telling you about this transaction. This is, I'm sorry to keep saying this, but it's exactly the opposite of how the courts below have treated this case. It is not a case about I've consumed employee resources and what's more under the recharge I'm paying for it. It's not that. It's somebody's issued an equity option. We've got to deal with the debit somehow. And if a parent company's done that, it's a capital contribution. And the dealing with the debit somehow is, you don't get that as an asset, it goes to P&L. Absent recharge, same thing. Even though no cost, no sacrifice of assets. That you've seen now, that's uncontroversial. And that's why I'm saying the recharge, the reason I keep saying, I'm not inviting this court to say the case is standing behind this one with no recharge, we win those, but where there's a recharge, the taxpayer wins those. That's wrong. It's a wrong approach. The recharge is paying the parent for issuing an equity option, not for consuming. Now, that's what I have called the archaeology of the debit, with or without the recharge. Then I go on to interrogating, well, where does that take me? And please, may I go on now to making my submissions on issues 2 to 4. Now, my Lady Rose put it in, this morning. She said, well, you've got two, I mean, I paraphrase, but you've got two big messages. Big message number one, there are certain circumstances where you don't even get to look at the accounts. You shouldn't be looking at the accounts. Message number two, well, even if you did, if the interrogation of the debit means that conditions, in this case for relief, looking at section 54 in a word like incurred, or wholly exclusively for the purposes of, or asking if it's revenue or capital, that's a more granular approach. And your fundamental point's a fallback, isn't it? I paraphrase, but I hope I've put the point my Lady Rose put fairly. The reason I'm taking issue 2 first, which is there a world in which a court, this court, any court, has mandate to not even look at the accounts? It's obviously a critical question. It's a huge question when you're faced with something like IFRS 2. And
it's not really a new argument. So it's been argued in a number of cases that accounting standards failed to reflect what was genuinely happening and failed to produce a realistic figure for the profit. And these arguments haven't been accepted.
And the reason, my Lord, they haven't as yet been accepted, in my respectful submission, looking at the case law, is that, repeating what I said just before lunch, in each and every case, what was being pleaded by whoever was pleading it, usually the revenue, sometimes the taxpayer, actually, a case like Gallagher and Jones is, we've got an accounting standard that's trying to measure profits. That's its objective. Doesn't reflect what's happened in the real world. I've paid some money, and in a case like Gallagher and Jones, I'm getting the deduction on a paid basis. And absolutely right, the court has said, well, it's all to do with do the accounts reflect a profit in a true and fair view? If they do, deal with it. That's what we... Here I'm saying IFRS 2 is expressly acknowledging that there's a debit where there's no outflow of cash, no sacrifice of assets. I've done the recharge point to death. In every case that is in this bundle, there's either we're dealing with something like a provision, so there's a real liability out there, a case like Jenner's, a case like Britannia Airways, or there's, as it were, a real-world expense in the sense of pound notes having been paid, but the expense has been spread because the accountant says it's a more true and fair view of what? Computing those profits for each year. Here, unless you dismiss what I'm saying as rhetoric, IFRS 2 isn't doing that. The reason the debit ends up in the P&L account is because it shouldn't be recognised as a balance sheet asset. That's why I've said over and over and over again.
But you've made that point clear, but nevertheless, according to the best practice of accountants, the figure properly appears as an expense in the profit and loss account.
And my response to that is, in those circumstances where it's not even a question of there's a disconnect, a dissonance between commercial reality and accounting computations, the accounting computation isn't even trying to compute profits. It's doing something other, and it's just a consequence that you've got this debit.
Surely it is. If you're treating it as a debit, profit and loss account, it is part of the calculation of profits, isn't it?
And the accounts will have been drawn up in accordance, presumably, with the Companies Acts, under which a company's accounts must give a true and fair view of the company's financial position, and they need to be compiled in accordance with by government-approved accounting standards. And we don't have evidence about, well, it's not a matter of evidence because it will be a statutory instrument, but normally accounting standards like this are approved for that purpose.
This issue too is addressing the question, yes, even though you've got a debit to profit and loss account, I don't accept, in response to my Lord Sales point, it is computing profits. It's putting the debit and depressing the accounting profits, sorry, I'm going to have to say this again, in an effort to preserve the balance sheet. By contrast to those accounting standards to say this is the proper way to measure profits, there is a difference between the two.
So you rely on that difference as then requiring or authorising any adjustment in the tailpiece of Section 46.
Exactly right.
Yeah. So, but is that something you're asking this court then to do, and henceforth there will be, we are authorising or requiring that adjustment to be made when, as you say, a debit on the profit and loss account is only there because it can't properly be treated as an asset in the balance sheet. I don't think you've pointed us to anything that says this law or this case tells you that in those circumstances the tailpiece of Section 46 comes into play. That's what you're asking us to create in a way.
Yes, and I'm about to take you to the passage in Gallagher and Jones, which I say absolutely gives juristic mandate to depart from accounts. Now,
sorry, just before we move on from this point, you say there is a difference. I'm struggling to see what the difference is. I mean, surely accounts have to give a true and fair view. There will be a profit and loss account and a balance sheet, and the two hang together and may affect each other. So I'm struggling with this distinction that you're emphasising to us about accounting standards directed to working out profit and loss as opposed to preserving the integrity of the balance sheet. I mean,
call it objective.
Is that a viable distinction to draw, where the accounts overall have to provide a true and fair view and the two elements may affect each other?
Yes, I think it absolutely is for this reason. It's a question of objective. Where accounting standards have the objective of saying this is a better way to compute profits, and my Lord Reed is looking already sceptical, but...
yes, because I don't believe that the division you're drawing between giving a true and fair view of the balance sheet and giving a true and fair view of the profit and loss account is a sustainable distinction. And it's a statutory duty under the Companies Act 2006 for companies to submit accounts to Companies House which give a true and fair view of the company's affairs, including its balance sheet and also its annual profits. And Lord Hoffman in the William Grant case tells us that the starting point is the true and fair view of a company's profits, and then you make any adjustment which is expressly required by tax legislation.
Well, let me respond, and then let me show you the passage I want to show this court in Gallagher and Jones. No, I don't accept the observations made either by my Lord Reed or by my Lord Sales. The profit and loss account measures profits and measures losses. That's what it does. The balance sheet shows assets and liabilities. That's what it does. To say that where the reason for the diminution, the depression of profits is because the quality of what would otherwise go into the balance sheet isn't good enough, it's because it's consumed on receipt. The answer to my Lord Sales as to how do you make the distinction about when do you follow the accounts and when do you not? How can you tell? Is you ask, what was the draftsperson of this accounting standard trying to do? Were they trying to measure profits? No. They were sacrificing the true measure of profits to preserve the integrity of the balance sheet.
I mean, that way of putting it, it's almost as though you're saying, well, let's have a true and fair view of the balance sheet, and it doesn't, if the profit and loss is distorted and not a true and fair view, that doesn't matter. I mean, why wouldn't one say that the draftsperson of IFRS 2 is seeking to set out an accounting standard which will achieve a true and fair view across the whole of the accounting statements of the company, both profit and loss and balance sheet? Why does one have to narrow it down just to profit and loss?
You look at because profit and loss is what the tax code is looking at. That's the point. They're not looking at the balance sheet.
I'm looking now at the relevant provision. It's section 393 of the Companies Act 2006. The directors of a company must not approve accounts unless they are satisfied that they give a true and fair view of the assets, liabilities, financial position, and profit or loss. So all aspects, both the P&L account and the balance sheet, are covered by the requirement that the accounts give a true and fair view. And the whole point of accounting standards, given statutory approval, is to meet that requirement in accordance with the best practice of the accountancy profession.
Please don't underestimate how much I understand that. I get that point. My point is, despite complying with being true and fair for Companies Act purposes, despite that, in a world where the profits are depressed, reduced, for a reason which is not to do with the computation of profits, but to do with something else, something other, and for reasons I'm about to show you, that is a reason when you're looking to compute profits for tax purposes, you don't pay attention to that diminution, that reduction of profits. That's what I'm saying.
Right, so you're saying that for the corporation tax is only interested in profit and loss. It's not interested in the overall true and fair view. So if it may be that there are two sides of the equation that have to be balanced out for the true and fair view purpose, but that's not what the tax code is dealing with. It's mostly dealing with what is the taxable profit.
Exactly right, my lady. That the true and fair quality is a combination of the balance sheet and P&L looked at together. And yes, each has got to be true and fair, but in conjunction with the other.
The starting point for this debate, I thought, was what was the purpose of the drafter of IFRS 2? Surely the purpose of the drafter of IFRS 2 is to produce a standard which means that the whole of the financial statements give a true and fair view.
Well, I think that's what my Lady Rose has just said, and I agree. But the tax code is only looking at the P&L account. It couldn't give a fig about the balance sheet. And the problem is what the tax code does, and this is a problem, is it can't have regard to the balance sheet. It doesn't look at the balance sheet. It can care less about the balance sheet. And so although something is true and fair if you look at it with the balance sheet and say, well, this debit is because it can be reflected as an asset, you can't do that in tax. You simply can't do that in tax. You look at the P&L account, nothing else. And that's a problem. Where the P&L account is true and fair if you look at the balance sheet because that shows the capital contribution or that. All the P&L account shows is this debit. And looked at in isolation away from the balance sheet. That's another way of putting it.
How do you... The P&L and the balance sheet don't live in sort of different worlds that fail to speak to each other. The balance sheet in year one will move upwards or downwards when expressed again in the balance sheet for the next year by reference to how much profit or loss there's been. Yeah. They're part of a seamless whole.
They might be part of a seamless whole, and for something that brought forward P&L reserves, that is true. But here, I can't put the point any clearer, and the court's got it. The only reason for the reduction of the profit is because the drafter of IFRS 2 says the thing you I'm calling consideration for the grant of the option is insufficiently permanent. It's consumed on receipt, so it goes in as an expense. And that, if you look at the P&L in isolation, I say gives a misleading, wrong picture of what the profits are.
And it's the profits that are the relevant thing for corporation tax.
Absolutely right, my lady. And that's why I'm saying that I don't need to be told that the balance sheet and profit and loss, you look at them together, and they operate in the same world. That is true.
But if your case is that the effect of applying IFRS 2 to this notional consumption of employee services is that the P&L is unduly depressed below what it should show to give a true and fair view, then it will follow that when that P&L finds its way into the next balance sheet, so will the balance sheet be.
That, I think, well, no, the balance sheet wouldn't be, that's the point, because what keeps happening in this sort of transaction is for the holdco, there isn't, which is actually issuing this option, nothing happens, because it's always going to be credit liability to issue shares. I've made my subsidiaries more valuable, debit asset subsidiaries. That's always going to be an ongoing thing. For the subsidiaries, yes, their balance sheet will show lots and lots of capital contributions and lots of P&L debits. So I don't see that what I'm saying is undermined by saying, if you look at this on a year-on-year basis, my submission's at all undermined. It's not.
But well, if I may just follow on from what Lord Briggs said, I understood the point that he was putting to you was that your theory is IFRS 2 is about preserving the integrity of the balance sheet. But since it has an effect on profits, which themselves will affect the balance sheet in the future, doesn't that theory break down? There is no integrity, pristine integrity of the balance sheet, which is preserved by IFRS 2.
No, I don't think it does, because the whole point is that whatever happens thereafter, that debit just stays put. So the balance sheet is unaffected by that debit just being there. Its integrity is preserved. That's why I say, you look at the next year, with or without a recharge, I'm barely speaking about it, but with or without a recharge, that debit is preserved because the notional consumption of employee services has been consumed. So even though you've recharged it, that doesn't change. So the balance sheet stays, as it were, correct. Holdco has issued, parent co has issued an option. I've paid Holdco for the issue of that option. Both balance sheets of Holdco and paying sub are correct. The only, I suppose, effect on the balance sheet is that there are less reserves to transfer into the balance sheet. But there, what's important is my instructions are this debit does not reduce distributable profits. It's not like Smith & Nephew, which my Lady Rose will remember. There, the foreign exchange debit, which the taxpayers claimed, was the result of a valuation, because that's what FX is. That's what foreign exchange is. So it wasn't a surprise the taxpayers won, because what foreign exchange usually is valuing an asset as against one currency at one time, then matching it against the valuation at a different time. And that did diminish distributable profits. Now, if the court wants me to make that good, that this P&L debit does not diminish distributable profits, then I will hand the court up a note, and Mr. Monk can respond as he likes. But I don't accept that the balance sheet is somehow impaired by my submission, that it's the depression of the profit and loss was somehow wrong. Please may I show, because I need to get on to my other submissions, but and this is going to inform this issue too. It's Gallagher and Jones, the court may be familiar with it, tab 14, and I'll go straight please to page 525.
Are you disputing that the P&L account gives a true and fair view of the profits?
For Companies Act purposes, no, looked at in conjunction with the balance sheet. The controversy that you've seen meant that, as it were, the real worlders lost out, and what was thought to be true and fair was the IFRS 2 view of the world. So I'm not disputing that for Companies Act purposes.
Are you disputing that the accounts give a true and fair view of the profit for tax purposes?
Yes, I absolutely am. Of course I am. I mean, the notion that a company, if there's been no recharge, has its profits diminished and gets a tax deduction, how's that true and fair to anybody?
Is this a way of putting it, that you think that you accept that the accounts as a whole are a true and fair picture of the affairs of the company because the debit in the P&L account is matched by an entry in the balance sheet. But for tax purposes, the entry in the balance sheet is irrelevant. And if you're not going to take that into account when assessing corporation tax, which you mustn't, then you say you also shouldn't take into account the debit which is there for that purpose.
That's another way of putting it. Exactly right. Exactly right. And so
the way Lord Hoffman put it in William Grant was that the requirement that the initial computation shall give a true and fair view. This is before you make deductions, which the taxing statute, before you make any adjustments expressly required for tax purposes. So at the stage before that, the requirement that the initial computation should give a true and fair view involves the application of a legal standard, he tells us. But the courts are guided as to its content by the expert opinions of accountants as to what the best current accounting practice requires. The experts will in turn be guided by authoritative statements of accounting practice issued or adopted by the Accounting Standards Board, which is what we're dealing with. So you're asking us to go beyond that and say that there's a standard which exists independently of accountancy standards, which we're to apply instead in order to arrive at a true and fair view for tax purposes, something which I think Lord Hoffman tells us has been consistently rejected by the courts.
What I'm saying, my Lord, is that, and please, my Lord, recollect, in William Grant, as in every other case where that sort of observation and diktat was delivered by the court, was dealing with an accounting standard that had the objective of measuring an accounting profit. There was no analogue to this, which says, we know the profits haven't been diminished in the real world, but we're going to put the debit there anyway.
Well,
so,
I mean, we didn't go into the detail of the case, but it was quite a complex. It was also about the interplay between balance sheet and profit and loss account. It was how you dealt with depreciation, whether it could be carried, whether it ought to be treated as an expense in year one, or whether part of it could be carried forward in the figure attributed to stocks in the assets.
My Lord, respectfully, no. It wasn't to do with the interplay of balance sheet and profit and loss in the sense that I'm talking about here. In William Grant, you had these machines. They cost some money, and you allocated some of the cost of those machines to stock that was sold in the current year. The other costs got capitalised, but then were set against in the P&L account the stocks that were sold in the subsequent years. And what was said is, well, what's wrong with that? Because what you're actually doing as an accountant is recognising that part of your cost of sales has attributed to it part of the cost of these machines that make the stock. And put like that, it's quite straightforward. But the revenue, actually, we're saying in that case, I know we had to go a long way, but what the revenue we're saying in that case, and they could be accused of hiding behind a technicality, is what they were saying is, that's not really what's happening. What's happening is that you're taking, you're not just allocating the cost to current year assets and then to future assets, you're getting rid of all of it, then adding some of it back, and that falls foul. Well, that's not this case. There's not the interplay of balance sheet and profit and loss that we're talking about. But please, can I just show you this, because it's going to help. Page 525. Now, Gallagher and Jones, it's the paragraph that starts this authority.
Are we in the judgment of Lord Bingham? Or
Yes, it was the Master of the Rolls then.
Yep.
Now, well, actually, if the court would very kindly let me know when you've read that.
Which passage do you want us to read?
My lady, it's the paragraph that starts, this authority is of obvious importance, and it finishes with the word, no alternative principle of commercial accountancy is advanced. And once the court's done that, if it kindly lets me know. Please may I invite the court to look at page 529 under conclusions. And once the court has read those two paragraphs, I want to make some submissions. Please may I make my submissions. Before we get to what is now section 46, Lord Bingham himself said, of course you follow the accounts, where else would you start? But with two caveats. One, if they're inconsistent with the true facts. Two, otherwise inapt. So he leaves, before this case law got codified, he leaves room for this sort of case. And as it happens, if you look at the previous page where he quotes the Vice-Chancellor, my Lord Pennycook in Odeon Theatres, this is a phrase that crops up over and over again. When he quotes it, it's towards the top of the quotation. It begins, I think, in deference to the arguments. The second sentence, the concern of the court is in this connection is to ascertain the true profit of the taxpayer. That phrase, true profit, crops up in a number of instances. Now, this takes me to this place, and it's as simple as this. Looking at section 42 of the 98 Act, when it came in, it codified this case law.
Sorry, we have a page.
That's section 42 of the Finance Act.
Yes, I'll give it to you. Just give me a moment. 346.
Thank you.
And if you look at 346, And if you could also please look at 348. That's section 46 of the 98 Act.
Was this the first time that tailpiece had been introduced?
Yes. So if the court lets me know that, when the court's read section 42 and section 46. If I please may make my submission, what the court sees is that tailpiece is there, as my Lady Rose has said. That's the first time those words were ever introduced. They're not a synonym for, unless the context requires otherwise, they're not a synonym for subject to express statutory contrary provisions. There's something very different, probably unique. Authorised, required or authorised. The notion of authorisation is a sort of permission. Now, for your note, at electronic bundle page 1032, you'll find the explanatory note to section 42. And at paragraph 15, it says in terms, save in exceptional circumstances, it requires the adoption of published accounting standards. So again, the explanatory note is leaving room. And by the way, you'll have seen when you looked at section 42, that's what says you follow the accounts. Section 46, under the heading minor and consequential provisions, that said, look, we don't follow the cash anymore. So that's dealing with accruals and provisions. And that's, as it happens, that's explained in the explanatory note, just for your note, at page 1035. Now, question, what's that tailpiece doing? What is this? What's the scope of departing from looking at the accounts? Because that's what it's saying. When that tailpiece applies, you don't look at the accounts. Unless otherwise required or authorised. And if you want a contrast to subject to express statutory provisions to the contrary, section 48(3). So it's not that. In my respectful submission, the wisdom of Lord Bingham in leaving room for not even looking at the accounts when they don't reflect the true facts. True meaning what? True meaning commercial, the business of commercial accountancy. Or otherwise an act. You leave room. Because ultimately, what Parliament isn't doing, because of this tailpiece, is ceding the computation of, the computation of taxable profits to the accounting profession. So if accounts are true and fair, that's the end of it. Because Parliament said so. Well, Parliament hasn't said so. And in case Lord Reader reminds me again, the diktats over and over and over again about look at the accounts, don't depart from the accounts, where would we all be? They were all accounts looking to compute profits. They were nothing like IFRS 2. It's not good enough to say, well, they're true and fair for Companies Act purposes. Because as my Lady Rose has said, and this is obvious, the computation of taxable profits looks at P&L, possibly other income statements, That's it. You don't get to look at the balance sheet. That's what distorts the computation of tax by contrast to the computation of accounting profits. Now, that tailpiece can mean one of two things. It can mean something quite wide, which is the courts have got permission, in the Lord Bingham sense, if the accounts don't reflect the true facts, or they're otherwise inapt, they leave room, just as Lord Bingham did. And just to be clear, Lord Bingham was saying what he said in Gallagher and Jones, where what had happened was the taxpayer had made a massive payment, a real payment, a premium for a barge, a boat. But the accountants spread that payment over a number of years. And what the taxpayer was saying is, look, I've paid it all, I want my deduction. These are real pound notes here. Accountant said, that's not true and fair. Spread it. And the revenue won. And what Lord Bingham said is, that's right. SAP 21, I think it was, in finance leases. That's trying to measure profits. Nothing wrong with that. Nobody's saying it doesn't accord with a true view of the facts, that payment you've made is to be matched on a year-on-year basis with the profits you make from that boat. It's not otherwise inapt. We'd stick with the accounts. But he's left room. So that permission, that authorization, it can either mean something very, as I say, something wide or something narrow. Something wide, which is, yes, exactly, in the Bingham sense. Parliament hasn't ceded the computation of tax profits to the accounting profession. So the courts have room, and that's why the explanatory note says, save in exceptional circumstances. Exceptional. I'm saying this is one of those. Or it can mean something narrower, which is it preserves pre-Section 42 cases. There's a very curious phase, required or authorised by law. Now,
I mean, doesn't Lord Hoffman explain what it means in paragraph 1 in the William Grant case? Mm-hmm. Because the phrase required or authorised by law comes from the Sir John Pennycook judgment, is lifted into the statutory code, but paragraph 1 in William Grant, page 1020, 22, I think it is, Lord Hoffman says what it means, which is that you take the accounting standards and then you make any adjustments expressly required for tax purposes, such as adding back deductions.
No, my lord. I don't take that as giving an exhaustive meaning of that tailpiece, and neither does Parliament. Please, may I take you to page 1054, and I'll tell you what this is before I make a submission on it. The court may know. I mean, please don't feel insulted if it's obvious, but the court may know that for a trader, please may I make my submission before you, it will inform reading this.
I'm so sorry, which page do you want?
I'm on 1054.
I'm saying no page numbered.
I think you meant 105.
Yeah, 1054.
Oh, thank you.
Oh.
Now, the court will know that as a pure judge-made rule, in a case called Sharkey and Werner, if a trader appropriated trading stock, there was a market value figure which was put into the trading computation. So the court may remember that, and that was applied in lots of future cases like Petra Jimenez. Sharkey and Werner got codified, but it was 2008 when it got codified. So between 1998, when Section 42 came in, and 2008, there was no statutory provision which gave a Sharkey-Warner effect, yet everybody applied it. This is the explanatory note that codifies Sharkey-Warner and puts it into statute for ITOIA 2005 purposes. But until 2008, it was just a case, nothing else. So that's what's happening. And if the court, please, turns to page, it's paragraphs 21 and 22, it's pages...
Where did Sharkey and Werner get it from, then?
Oh, Sharkey and Werner, it's actually in the bundle of authorities.
Yeah.
What the House of Lords said was there's no accounting evidence. We think the most sensible answer
Oh, I see.
is market value. It surely can't be costs, because Lady Werner had diverted this horse from business use to private use, and it must be that it's the market value of the horse that should come into the computation. That's what the House of Lords decided.
So they created this little rule, and you say everyone applied that rule, and if one was looking at it in a modern way, one would say what they were actually doing was applying the tail piece, which is now incorporated into the legislation. And
thank you, my lady, yes. And that's confirmed by paragraphs 21 and 22 of this explanatory note at 1057 and 1058.
The way see also, as well as Lord Hoffman, Lord Hope in the Grant case at paragraph 38 tells us the golden rule is that the profits of a trading company must be computed in accordance with currently accepted accounting principles. They are the best guide as to a true and fair view of the profit or loss of a company in a relevant accounting period. Profits so computed are subject to any adjustment required or authorized by law in computing those profits for corporation tax purposes.
That's right. And in William Grant, the golden rule was not departed from. But there's room to depart from it. That's my point.
And it goes on, but there is no rule of law that prohibits effect being given to what currently accepted accounting principles provide as to how a true and fair view is to be arrived at.
That's right, because in William Grant, we were in a world where, as I say, intuitively, if you explain William Grant as saying there are cost of machines, they produce stock.
Well, intuition's no guide here, really. I mean, Section 46, for example, of the Finance Act tells us that, well, we can see it in page 348, I think it is. Yes, when it's talking about the computation of profits, and it says references to receipts and expenses are to any items brought into account as credits or debits, and adds there is no implication that an amount has been actually received or expended. So, I mean, if that's the case, intuition isn't really, I mean, this isn't about intuition.
Please may I respectfully disagree. The point about no money having passed, you've seen that in Section 46 already of the 98 Act. It's simply dealing with provisions and accruals, and I've given you a page number telling you that's what it's dealing with. And coming back to your intuition, I was simply explaining William Grant in a very simple way, and it is simple. You've got machines, they cost money, they make stock. What the accountant said was, best way to deal with that, to compute profits, to give a true and fair view of profits, is to allocate the cost of those machines to stock. This year's stock, straight away. Next year's stock, you release something that was capitalized in the balance sheet. Does that make sense? Yes. That's it.
But the importance of the case isn't the decision on the facts, but the principles which were laid down by the speeches.
I understand that. And the principles laid down by the speeches were considering, and that's the trouble. If you take those speeches of those courts as statutes, you're going to have a problem. Because you need to deal with the case that is facing this court and say, well, in a world where you've got this, what I'm calling a debit disconnected from commercial reality, then you are in that caveat of Lord Bingham to say, well, it doesn't reflect the facts. It is otherwise inapt.
Well, I'm not sure it's helpful to refer to commercial reality, because I don't think that your case really relies on this being more commercially real than the counter case. Your case relies on there must be some meaning given to the tailpiece in section 46. Lord Bingham hints at what it was. It didn't apply in William Grant, but it's different wording from what the statute uses when it's only excluding express statutory provisions that prevent you from making deductions. And what is it? If it's anything, it's this case, I think you're saying.
I think that's a fair way of putting it, my lady. Thank you very much. But the reason I mentioned reality, call it truth, is because what Lord Bingham said was the true facts. That's all I'm saying.
Yes, but I don't see you as making a wide principle that whenever the accounting principles, whatever they relate to, don't reflect what one intuitively feels is commercial reality, then you can...
No, I'm not saying that.
And I think you're relying on this particular quirk of what you say is the different purpose of this particular debit.
Yes, I am saying that. So I'm not saying that there's a perfect, innocent notion of commercial reality and we've all got to comply with that, including accountants. I'm not saying that. I'm saying that we're in a world where there's a complete disconnect to profits and the application of the accounting standard. Why do I say it's complete? I mean, I don't want to go over all that again. I say it's because the only reason is preserve the integrity of the balance sheet.
You've sought to give particular emphasis to the words "or authorised" by law. But I wonder whether that really is a serious point of distinction. What I rather took Lord Hoffman and indeed Lord Hope to be saying in William Grant is you start with the accounting principles and you take the profit and loss from them, unless there is something which will be in statute which says, no, you shouldn't do that. You shouldn't treat something as either a debit or a plus in the profit and loss, or, and this is the authorization bit, you have an option whether you do or you don't, but it's an option given to you by law. And so far, you haven't pointed us to anything of that character in this case.
If you're confining the word law to the word statute, then I agree, but I'm not.
But that's what Lord Hoffman, with whom everybody else agreed in William Grant, tells us section 42(1) means. He says, then you make any adjustments expressly required for tax purposes. The classic formulation of this method is by Sir John Pennycook, and it has now been codified in section 42(1) of the Finance Act 1998, and then he quotes it.
But I can happily...
So that's what they were dealing with.
I understand, but I can happily accept that. And I'm saying that in fact, Sir John Pennycook, when he talked about the task of the court is to ascertain and identify the true profits, that was quoted by Lord Bingham when he said you leave room to not look at the accounts. And that is what was codified, is that case law, that very case law that was codified in section 42, which is what Lord Hoffman is saying.
I think we're going round in circles. It might be best to move on. You've got quite a few issues remaining to deal with between now and 4 o'clock.
Let me try. If you hold on to those submissions, because that's issue 2 is, put short, in a case like this, you can rely on the tailpiece to not even look at the accounts. And if my Lady Rose articulated it, if not this case, when? When are you ever going to do it? And I don't accept what Lord Hoffman's saying is anything that prohibits that approach. It's the opposite. Turning then to what I'm going to call the more granular points, to say, well, let's say you do get to look at the accounts. Let's say that's true. You do. This is issue 3. So what does that mean? It means absolutely you plug in the debit into the tax code. And now you're interrogating the debit by reference to statutory conditions. So you start with section 34, so that tells you at page 359. This part is all to do with computing the profits of a trade. 46. So that's what we've been looking at. In accordance with generally accepted accounting practice, subject to any adjustment authorised by law. Bracket, please might the court bear in mind my submission that the explanatory note to the predecessor of this, section 42, said, save in exceptional circumstances, you follow the accounts. And Sharkey and Werner was a case, not a statute, that was applied by everybody until it was codified into statute in 2008. And didn't comply with GAAP. That rule that the House of Lords constructed was not GAAP compliant.
I thought you said that there was a gap in GAAP. So it didn't conflict with GAAP, it was just filling a lacuna.
The explanatory note says it conflicted with present-day GAAP. So if you were following GAAP, you couldn't apply Sharkey and Werner, but everybody did.
Okay, thank you.
Then you've got section 48. It's on page 362. And you're told, in the context of the calculation of the profits of a trade, references to receipts and expenses are to any items brought into account as credits or debits. And little 2 is an analogue to section 46 of the 98 Act, simply dealing with provisions and accruals. And there you've got, call it a tailpiece in little 3, which is completely different to the tailpiece in section 46. Now, the point to bear in mind about section 48 is it's not a computational section. It's a definitional section. It's saying whenever you see the words receipts or expenses, read in the word debit. The reason this is important is because what, in my respectful submission, the courts below did was to say, you're telling me that a debit is an expense, it's therefore deductible, and the rest of it, the it being the decision in the case, follows. Once you've conceded, because you're looking at section 48, that you've got a debit and therefore an expense, it's section 48 that tells you, aha, it's deductible. That is simply wrong. It's simply defining the word expense as meaning debit. Then section 54, page 364, please. So I say, all right, if you take the granular approach, you look at the accounts, you don't accept what I'm saying about the tailpiece. You look at section 54 and you ask, in calculating the profits of a trade, no deduction is allowed for expenses not incurred wholly and exclusively. So that's 2 conditions. There's got to be the expense, the debit has got to be incurred, and it's got to be incurred wholly and exclusively for the purpose of a trade. So the pressure is on I've got two terms to deal with. One is incurred, one is holding exclusively for the purpose of the trade. I say the IFRS 2 debit, whether or not you look at this recharge, is not being incurred by anybody. It arises why? Not because you're consuming employees' resources. That's where it's to describe the case as that is to be misleading in a very serious way. The debit arises because Parent Co issued an option. The value of that option is reflected in the incentivization of employee services. That's what can't go into your balance sheet, it goes into your P&L. It's not incurred. Then, what about the recharge? What about this recharge? If you remember the accounting, you are not paying for the employee services. I mean, that's wages. You're paying Parent Co for having granted the option. Now, where there's no recharge, nothing's been incurred. And actually, the drafters of IFRS 2 accepted that. That was the whole point about there's no cost, no sacrifice of assets, all that. And that's what throws up the debit. It is not the recharge. And if expense means debit, it can't be something that you can look to the recharge to ask whether something's been incurred. Now, before the lower courts, I relied on Lowry. I didn't get a chance to address it orally in the Court of Appeal because I was too pressed on other issues, but it was in my skeleton, and I get to air it here. In Lowry, I'll show the court this in a minute, a company issued shares, but they issued them cheap. They could have issued they issued them at par instead of issuing them at a premium. Question: was that an expense? And the provision used to say laid out or expended. That's what's morphed into the word incurred. Held by the House of Lords, the majority, no. An opportunity cost like that isn't laid out or expended. And I'll take Lowry short, not because it's not important, but I can show you the relevant passages quickly. It starts in the electronic bundle at page 421. And then at 422, you'll see what the revenue were arguing. If please, the court, if you see where it says Sir Terence O'Connor, Solicitor General, does the court see that? Yeah. What they were arguing was the issue of these shares at par and not at a premium. What the Solicitor General was submitting was there was no disbursement, no loss suffered. So it wasn't to do with the accounts. It's a very old case. It was dealing with Schedule D of the 1918 Act. But it was construing the phrase laid out or expended, which is morphed into, as I say, this word incurred. And taking it short, starting with Viscount Caldecott, at page 423, he says, first of all, the tax charge at the other end is irrelevant. He says that in the paragraph towards the bottom of the page that says, I find no guidance from the fact that the employees have had to pay income tax. Do you see that? And then at 424, towards the bottom of the page, it's the second last paragraph, which starts, I come back to the facts of this case. And he says, look, put short, nobody spent any money. It's as easy as that. Viscount Mom. At 426, he says, well, all of this might be capital in any event, but in the next paragraph, the one that starts, there is one other fact of importance. The issuing company wasn't discharging a debt or liability, nothing like that.
In this case, there was no accountancy principle requiring it to be treated otherwise, was there?
That's right. That's exactly right. We're construing the words, and the reason that's important, my lord, is because having plugged the debit into section 54, we're asking, has it been incurred? And they're saying, well, if incurred means laid out or expended, no. So my response to my Lord Hamlin's question is no and quite. It's the whole point is that you've got your debit. You're saying I've got to look at it. I've got to plug it into section 54. There it is. I've done that. Has it been incurred? No. There were two dissenters. I mean, that's all I need to take from Lowry, who said, "Oh, come on, they could have issued these shares for a much bigger price. They're trying to benefit their employees. Surely that's an expense that's been laid out or incurred." And the majority said, well, no, they haven't spent any money. So if you plug in what section 48 tells me to do, if you're making me look at this debit, into section 54, you replace the word expense with the word debit and ask, has it been incurred? And the answer is no. Similarly, with as it happens, the upper tribunal looked at this very issue in Genius. And I'll just give you the reference. It's tab 16. And it's paragraphs 455 to 457 at page 668. In Ingenious, I think my Lord Sales, I've lost track of how many of these cases there are. But anyway, it was a film scheme, and 30 was put in by investors. The partnership spent the money all right. 70 was contributed allegedly into the partnership, but went straight to the production company, and it was always destined for the production company. And what was said is, well, the partnership hasn't spent anything. And in looking for the word incurred, what the upper tribunal said is you haven't incurred anything. You've suffered no economic loss, no economic burden. And here, just in case this court's thinking of doing it, if you're thinking of plugging in the recharge, that was to repay for the grant of the option. Now, what the lower courts did, and for your note, the FTT is at paragraph 70, page 194, upper tribunal, paragraph 76, page 164 to 165, and the Court of Appeal, paragraph 42, page 140. What they did was to jump from section 48 to say, wow, expense means debit, to that must mean the expense is deductible. And that's simply the wrong approach. Section 48 doesn't give any relief for anything. Wholly and exclusively, so that's all I want to say about incurred. there's been no economic burden suffered on revenue account by reference to the recharge. And if you shut your eyes to the recharge, as you should, there's been nothing suffered or incurred by anybody. A lot of these options were not exercised. So even the parent company didn't have to issue shares. Now, and over and over and over again, when I made these submissions below, it was said against me, well, how can you say that? Which is a phrase that haunts me still, and, that nothing's been incurred. There was this recharge. Answer, that wasn't for the consumption of the employee services. That was to repay the grant of the option, which was the capital contribution. That's how it was accounted for. And again, there's no corresponding taxable credit in any of this. That debit that pops up in these two respondent companies, there is no corresponding taxable credit ever, either in the respondent companies or in the parent company, the holdco. What about, so those are my submissions on incurred. As I say, in respect of a trade expense, this debit has not, the debit has not been incurred by anybody. It can't be incurred by anybody. It isn't an expense. And the capital contribution doesn't disturb the debit, doesn't touch the debit. Remember, what is the debit? It's the consumption of these resources on receipt. That's why the recharge doesn't touch it. What about wholly and exclusively for the purposes of? And I'm going to show you Marley and Drummond, because it tells you what the test is, and Vodafone. And just for your note, there's an old case called Harrods. It's at tab 15, and it's an observation by Lord Diplock approving a previous House of Lords case called Strong and Woodyfield, that wholly and exclusively for the purposes of the trade, it's looking to whether it's looking to trade purposes, and it's with a view to earning profits. That's the gloss put on it by the House of Lords. Wholly and exclusively for the purpose of the trade means expenditure and revenue account with a view to earning profits, and nothing else. How do you find out whether an expense is wholly and exclusively for the purposes of the trade? Answer, you look into the minds of the taxpayer. All the cases say that. To conscious and subconscious objectives. And you find out if a trade purpose is infected by a non-trade purpose. So that is Malalieu and Drummond. Just for your note, I said I was going to show you it. It's probably easier to do it for your note. Lord Brightman's test is at page 768 of the electronic bundle. that approach is replicated, as you'd expect in all the cases, in a case like Vodafone, where one company, for its benefit, because it had a liability to a joint venture partner, pays out for the benefit of its trade. That's all right, that's deductible. This debit doesn't have a purpose. It can't have a purpose. It arose from a transaction where the option was granted by the EBT trustee. And like it or not, a debit appears in their P&L account, independent of the recharge. This debit arises because of the application of IFRS 2 and nothing else. Now, just to let you know, paragraph 17 of the FDT's decision, let me find it. Page 178 of the electronic bundle. Put short, what's said there is that there's little, well, he says there's little evidence that these respondent companies had designed the option schemes or required options to be granted, but they were required to make this recharge. So that debit arising on the grant of the option is not connected to any purpose of these respondent companies. And as I say, it can't be. Now, what the courts below did, and for your note, it's the FDT is 72 to 74 paragraphs at 195 to 196 of the bundle, the electronic bundle. The upper tribunal is 94 to 96, page 169, and the Court of Appeal is paragraph, was actually 54 and 55 at page 140 to 141. There's a running theme. This is all to do with consuming, and that's the problem, it's not. But this case, this debit, is all to do with consuming. Consuming what? Oh yes, these employee services. So, the debit must be informed by a trade purpose and on revenue account at that. And if I want to look at it, this is what the courts say below, look at the recharge. Goodness me, why would they pay that except for the benefit of the trade? And that's all wrong. This, as I said over and over again, but it needs to be said because the courts below have lost sight of it, and they never had sight of it, that this case is to do with the grant of an option. The debit can't have a purpose and the recharge can't inform the debit with a purpose. And in a world where there is no corresponding taxable credit, and actually for a while there's a double deduction, if this isn't a case where you either don't look at the accounts themselves or you interrogate the debit properly and apply words like incurred and wholly exclusive for the purpose of in line with the cases, then we can forget the tax code because we just find out what the accountants say and compute tax profits on that basis. And that is not, in my respectful submission, what my Lord Hoffman had in mind. And just to make this good, in the cases which are in this court's bundle, Gallagher and Jones has said that was all to do with this upfront payment of a premium for a lease of a barge, but that was spread by what? SAP 21. SAP 21 is to do with computing profits properly when you've got a finance lease. Johnson Britannia Airways, that's a provision. for a real liability. That's the same as Jenner's. So nobody's, as it were, not going to follow the accounts. Odeon, and there's lots of talk about accounts, but that was actual expenditure. The real question in that case was whether that expenditure was revenue or capital. And William Grant, yes, do you or don't you, in computing profits properly of stock, glue on the cost of the machines or the equipment that makes them? Yes, you do, held. But as I've said, the revenue didn't actually quarrel with that. They were quarrelling about, in truth, what does this debit really look like? And they were given very short shrift. That is not this case. And my learned friend saying it's about consumption of employee resources doesn't make it so. So if you interrogate this debit, section 48, you plug it into section 54, have you got an incurred expense? No. Have you got an expense informed by a purpose wholly exclusively for the purposes of the trade? No, you can't. Does the recharge affect anything? No. But the references I've given you to the decisions of the court below, they said, oh, this case is all to do with the consumption of employees' resources. And in my respectful submission, that's simply wrong. Same is true as it happens on my final point on capital, section 53 capital. Trouble is, when you get to capital, having spoken for so long, the attitude, if you're not careful, would be, well, goodness me, if you're not going to win on all the rest of them, how can you, are you really going to win on capital and nothing else? Well, maybe, but it deserves to win on capital. Why? Because why does this debit arise? It arises because the capital contribution couldn't be recognized as a balance sheet asset. What are you consuming? The it being consumed is the capital contribution. That couldn't be entered on the balance sheet and therefore was booked as an expense to profit and loss account.
Is that right? I wonder. If we go, I mean, I'm really asking for information here, but if one looks, if one goes back to paragraph 7 of the IFRS 2 document, we can find it on page 132 in the Court of Appeal judgment, paragraph 12. It begins by telling us that an entity shall recognize the goods or services received in a share-based payment transaction when it obtains the goods or as the services are received. So that's the first rule, and it applies to the subsidiaries, the companies, taxpayer companies we're concerned with, because they receive services from their employees in a share-based payment transaction. So they have to recognize them in their accounts. Then we're told how they're to be recognized. They're to be recognized as a corresponding increase in equity if the services were received in an equity-settled transaction, or they're to be recognized as a liability if the services were acquired in a cash-settled transaction.
My Lord, no. That's for a standalone company. So it's saying, say there was no, say a company had its own employees and did this. What they're saying is the thing that you're getting in what the accountant calls consideration is the incentivization of your employees. You're receiving services. Yeah. But so that's what we're treating as the consideration for the grant of the option. Because the option, as it were, that comes first. And we're trying to value it. How? By the increased incentivization of these services.
Obviously there has to be a share-based payment transaction. So in that sense, the share options come first.
And in this case, I'm sorry to interject, but in this case, because the parent company was the grantor of the option, and it was the subsidiaries that had the employees, that's why it was a contribution by parent code Civ. The subsidiaries, that's why you got the subsidiaries booking to its balance sheet credit capital contribution.
Well,
you won't get that from paragraph 7, you'll get that from the explanation given by the FTT.
No, you don't get it in paragraph 7.
No. And if you look at paragraph 7, 8 and 9, 8's got a telling phrase, assets that don't qualify as balance sheet assets.
Yeah.
So I say this, my lord, because my respectful response is you're not going to get anything out of paragraph 7 about my submission about the capital contribution and my submissions on incurred or submissions on wholly exclusively.
Well, paragraph 7 is obviously important because that's the one that ends up telling us that in the circumstances of this case, the appropriate way of recognising the receipt of the services was as expenses. But the starting point of paragraph 7 is the necessity to recognise the receipt of the services in the employer's accounts where the services are received in a share-based transaction such as one involving share options.
Yes, but the relevance of that is to value the share option.
Well, so you tell us, we've got that point.
No, but, my lord, sorry, I mean, the proposition, so I tell you, that's what the explanation actually is. It's the consideration given for the option. I'll show you.
Well, so that's what we're told. I mean, we obviously go on the facts found by the FTT, and we're told in the next paragraph, in the third sentence, that IFR 2 required the taxpayers to recognise an expense reflecting the consumption of the services, given the practical difficulty in measuring directly the value of the employee services received. The fair value of the equity instruments granted for those services was used as a surrogate.
Yes, my lord. And if you look at page 180, which is the explanation of this debit arising, as your lordship has recognised, it's the issue of the equity instrument which is being valued. The word consideration, this is BC 41. So what that is saying is, and that's why I'm saying this case is not to do with, the valuation of the receipt of employee services. It's saying the thing that's generating all of this is the grant of the option. How do we value that? Because you receive services, that's how we value it. That's all very difficult.
But that which requires the services, on the assumption they're immediately to be consumed, to be accounted for as an expense, is in paragraphs 8 and 9 of IFRS 2, isn't it? We've not actually quoted that at that point by the Court of Appeal, but we've got it at page 291.
That's right, but that doesn't undermine anything I'm saying. What paragraph 7 to 9 are doing is saying, look, IFRS 2 is all to do with the granting of options to employees. That's the introduction I showed you. How do we value that? The explanation as to why we're looking at this at all is what I've given you as set out by the FTT on page 180 at paragraph, 23 of its decision. So in my respectful submission, the key to this case is getting the interrogation of the facts the right way around. You're either looking at the grant of an equity option that has to be valued because it's there to incentivize employees, and so the value is treated as the incentivization over employees, surrogate being the fair value of the shares, which is what it says it is. Or you're saying, oh, no, because it mentions that employee services are treated as consumed on receipt. That's what this case is all to do with. That's what you look at first. And that's, I've said over and over again, that's wrong. You wouldn't be looking at that if the option hadn't been granted. And the only reason you're looking at trying to put a value of the incentivization of employees is because the option's been granted. You're trying to put a value on that. And because the benefit you're getting, what is said there is it's called consideration in the eyes of an accountant, is the receipt of employees' services which are consumed on receipt. You don't put it in the balance sheet, you put it in the P&L account.
But if you look at IRS 2, paragraph 8, page 291, when goods or services received or acquired in a share-based payment transaction, ... Well, the share-based payment transaction here is the option.
Yeah.
And the option, the effect of the option is to deliver into the company's lap the services of its employees, or rather the enhanced services of its employees. Yeah. And the enhancement is valued as a perfectly sensible commercial proxy at the value of the option. Yeah. But it's not saying that the fact that you use the option as a proxy just assumes that in this bargain something of equivalent value was swapped for the enhancement of the services.
But I can accept every word of that, and in a sense that's the point. Because what your Lordship has just said is the valuation of the incentivized services is trying to value the option.
No, it's not. It's using the option, the then mark-to-market value of the option at the time when the services are received, as the best proxy for the value of the services. That's how you, if you've got something of curious value that's swapped for a sum of money at a moment in time, you assume the thing is worth the sum of money if it's an open market transaction between a willing vendor and a willing purchaser.
It's about just wages and salaries. You know, you're recognising in the P&L account the resources consumed in order to produce the company's profits. And one of the resources is the payment of wages and salaries to its employees. And if there are share option incentives, then the cost of providing those the value rather of those share incentives are another cost of obtaining the enhanced services from the employees.
Let me, to be clear, tell you what I think, and then, of course, the court will map it onto what you're putting to me, but I don't accept the archaeology of the observation made by my Lord Briggs or my Lord Reid at all. What happened here was the grant of an option. In order to recognise that for accounts purposes, you have to value it. The it is what? Why are you doing it? You're trying to incentivize employees. So what is said by the accountant is, well, what we're doing, and it's that way around. You've issued an option to incentivize employees. To account for that, we're trying to value that incentivization. Well, that's too hard. We'll simply value the option. But the thing that has happened, is the grant of the option. As yet, not exercised. As yet, no outflow of cash or anything like that from the company.
I'm not making up the notion that the value of the services is to be applied by reference to using as a proxy the value of the options. It's exactly what IFRS 2 says at page, quoted by I think the first tier tribunal at page 179 in paragraph 25. But
my Lord, I'm saying that's right, but I'm saying that the significance given by that, at least this is how it appears to me by your Lordship, that's where it's problematic.
If you're right, why do you have to go round the loop of the incentivization of the employees at all? Why don't you, if what you're saying is one must look at the option and you've got to value the option, why don't you just say the value of the option is the market value of the option? Why do you have to go round this loop of saying, well, it incentivizes the employees and we've got to measure that, but we can't measure that otherwise than by... Then you end up by saying it's the market. But why do you have to go round that part of the exercise?
Because the fight they're having, which is set out in paragraph 23, is whether you should be doing any of this at all.
Yeah.
And some people are saying, look, just don't bother. Nothing's happening here. There's nothing to see here. They shouldn't be accounted for at all. And what this loop that my Lady Rose is mentioning is saying, well, something is happening because you're incentivizing employees. We want to measure that. It's too hard. We'll look to the value of the option. So that's the loop. So you start with, I want to incentivize employees. What am I going to do? I'm going to grant an option, but nothing's parted from yet. I haven't parted with any money, anything like that. But because I want to recognize that in my accounts, because I think I should, what I shall do is book a value equal to the option, because functionally what the option is doing is incentivizing the employees. That's too hard to measure. It's the market value, the fair value of the option. But what my Lord Briggs is saying on its terms is right. Of course it's right that the reason they're valuing the option is because the consumption, the incentivization is too hard to measure. That's true. That's 100% true. But the reason you're doing it is what my Lady Rose is calling the loop. It's saying the reason we're having this conversation, the reason that we're actually looking to put any entry into the accounts at all, is because, well, other options get recognised for accounts purposes. This one should too. How? You're not getting any money for it. Okay, we do this loop to say, well, the reason you're issuing the option is incentivising the employees. That's too hard to measure. We look at the market value of the option.
But it's because of going round the loop that you get into this problem that it has to be recognised in the P&L account rather than as an asset.
Right.
So that going round the loop creates the problem that you've identified.
And that's what the people who didn't like IFRS 2 were saying. That's why you shouldn't be doing any of this.
But that battle's been fought and lost, hasn't it?
It has been, but what we're interrogating here is whether the debit can be said to be incurred, because we're on issue.
Yes.
And I'm saying, no, it isn't.
So you're saying, well, you may have to go round this loop for the purpose of showing a true and fair picture of the accounts, but that's a different exercise from working out what taxable profits are.
And even if I can't put it as high as that, because that's the tailpiece submission, I do say, if you're interrogating whether it's been incurred, no, it hasn't. And that's why the significance, which I thought my Lord Briggs was putting on the valuation of the services being the option, you need to look at this picture the right way around. Step 1 is a grant of the option. Step 2 is, I've been told I've got to value it now. How do I do that? Okay, I'll just take the value of the option, because valuing it functionally is too hard to do. And IFRS 2 says, yes, absolutely right, do that.
It appears from the IFRS as if the accounting theory is that the P&L account should show on the debit side the relevant expenses, and the relevant expense here is the consumption of the employee's services, and that would be represented in the accounts most obviously by the employee's wages and salaries.
My Lord,
that's not the only value. That's not the only value attached to those services, because there is also the share option scheme to incentivize them. That's part of their remuneration package, effectively. And so it's properly an item appearing as an expense.
No, because in my respectful submission, Your Lordship missed out one vital step, which is the consumption is of the capital contribution, which had the effect of incentivizing.
You say that. I read paragraph 9.
My Lord, please can you reread let me find it. Paragraphs 31 through to 36. That's what tells you it's the capital contribution. You're not going to get the answer to the point that we're addressing here from paragraph 7.
No.
That's what
31 of
the FTT decision. I'm sorry, my lady. It's page 183 to 184. We've looked at this. That's what tells you it's not the consumption. This case is of services. It's the capital contribution which gives.
No, but with respect, that's other accounting entries relevant to the appellants. He's dealt at great length with the main accounting entry, which is the proper recognition of the value of the immediately consumed services as an expense. He's just going on and tidying up the loose ends.
No, that's how he looked at it. But this is the conversation I had straight after lunch. If you look at this by respecting both the credit and the debit, this isn't a tidying up exercise. This is saying, aha, I've dealt with the debit, credit's got to go somewhere, who cares, okay, I'll record it. That's what I'm saying. And your Lordship is, and I do say this, going to be giving a misleading gloss to this case if that's how you describe what's going on in paragraph 31 to 34. The whole point about the accounting credit and debit is that they both explain together what's happened. What the FTT has done.
I mean, I'm conscious of the fact we're rapidly approaching 4 o'clock and you haven't yet completed your submissions on issue 4.
Well, that won't take long.
We really shouldn't take up more time going over and over again the same points.
All right. In which case, please may I limit my response to saying, yes, it might be that these are described as other accounting entries as a tidying up exercise. That is what has misled the courts below. You have to look at both the credit and the debit to explain a transaction. And actually, this bleeds into the point I make about on capital. Because if it's right that what's being consumed is the capital contribution, and this court can't and shouldn't run away from that. That's the explanation the FTT's given. If you're going to respect the facts, and calling it tidying up is to disrespect 50% of the explanation of this transaction. Then the it being consumed, and I keep being told it's consumption of employee services. No, the it that's being consumed is the act of granting the option by the parent, which confers value on the subsidiary, and that's how it was accounted for. And the court will go seriously wrong if you confine attention to paragraph 7 and nothing else. I can close by saying this transaction, this case, is dealing with an issue of the equity option by the parent, the holdco. That had the effect of conferring value on the subsidiaries. That's the accounting. How? By incentivizing their employees. The relevance of services being consumed on receipt was saying that that capital contribution was being consumed on receipt. And it's not, and that's why I do object to my Lord Reid saying, well, so I say. It's not me saying it, it's them saying it. The FTT. In terms. And that's the key to this case, to understanding this case. And the trouble is, when I say that, the lower courts took it as a challenge to say, well, that can't be right. It is right if you respect the credit and the debit together, not one more than the other. And that's why it's a consumption of capital account. It's consistent with the reason that this debit arises in the first place, IFRS 2. Please give me one moment. Oh, yes. I can close very quickly. We haven't dealt with it. Dairy, it's paragraphs 84. Let me just find it. Oh, yes, 84 to 90. Yeah. Put short, number 1. What is stare decisis? It's a superior court that finds an inferior court. 2. How do you find that out? Parliamentary intention. This is a case called Gilchrist, which was a slightly more friendly juristic interaction I had with Lord Justice Richards, where we decided exactly that, because that decided that the upper tribunal is not bound by the High Court, because it wasn't Parliament's intention to do that. 3. What does that tell us about cases deciding pre-consolidation provisions which are then consolidated? Parliament at consolidation does not intend to change the law, and Derry tells us the rewrite didn't either. 4. What does that mean when we talk about the authoritative weight of a pre-consolidation decision? Yes, you look at the instrument that's been glued together, all the pre-consolidation legislation glued together. But if you want to know what that means, my respectful submission is what Parliament is doing is saying we know what these pre-consolidation provisions mean because the courts have told us. We're putting them all together in one new instrument so that you don't have to root around the old legislative instruments anymore. But the cases are every bit as authoritative as they always were. Otherwise, we're in a world where are we seriously being told Malilio and Drummond isn't the law anymore, etc., etc. And my Lady Arden's formulation, which is if the text is the same and the essence is the same, the authority of the decision post-consolidation, and I would say also post-rewrite, is undisturbed. And I don't upset Parliament by consolidating, says start again, forget the old cases. Literally forget them. So taxpayers can now self-assess on the basis that Malilio and Drummond isn't the law anymore. And all the court, including my Lord Reid, agreed with that.
Well, I think it was put in, wasn't it put rather guardedly by Lord Carnwath? One of the things we were struck by was how it rather defeated the object of the tax rewrite.
If you look at paragraph 10...
Right.
I'm sorry, which page are we on?
448.
Thank you.
So I'm being consistent.
I must be in the wrong case, I'm sorry. I'm sorry, the page number again was?
448.
Right. Right.
Lee Arden's analysis is expressly approved.
I don't believe it's a point on which the court was... it certainly wasn't one of the issues that needed to be decided in the case, as far as I recall.
Well, it's been decided. Well, I mean, I'm not going to quarrel. I'm not going to quarrel because.
Well, without reminding myself of what the case was about, I'm not sure that this is more than an obiter dictum, but we will see.
This court isn't bound by anything if it chooses not to be. I mean, I paraphrase the practice direction, but what I'm saying is my submission here is a principled submission based on parliamentary intention and parliamentary sovereignty. Yeah. When Parliament consolidates, it consolidates with knowledge, amongst other things, of the existing case law. So I adopt what's said in 84 to 89, and I respectfully say it's founded on good principle. Those are my submissions.
Well, there's section 1038, or you...
That's not in this case, my lady. 1038 and 1038A. 1038A was brought in to make sure that whatever happened to 1290, that there wouldn't be a deduction. And well, what I can say is, I remember when my Lord Reid said this morning, how dare you look at this, you can't look at this, it's subsequent legislation. That's exactly what Lord Hoffman did in paragraph 20 of Dextra. He said, look, the taxpayer's bleating, saying that section 43 shouldn't apply this way. Look, it's not that bad. Look at paragraph 24, which got enacted. That's all I'm saying about 103.8.
Yes, I understand that. You're not saying that it's a guide to the interpretation, except insofar as it demonstrates that the interpretation that you're arguing for would not be something that was inherently absurd or impractical.
Exactly, and exactly as Lord Hoffman did in paragraph 20.
Yes, I understand that.
But please may I help my lady?
No, I must have misunderstood it.
No, 103.8 was something
was relied on for the FTT in the UK.
Yes, but that's a completely different thing. It's not before this court at all.
Oh, okay.
That was where my submissions were described as ingenious, which really doesn't help anybody. With your permission, those are my submissions.
Well, thank you very much, Mr. Ghosh. Whether ingenious or not, you've at least put your case very fully. We're grateful to you. I think we'll adjourn now and resume at 10:30 tomorrow.